spoke, we had the results of the exit. In fact, we had, the exit poll predictions, and we were talking about where the markets will be headed once the state poll results were announced. And as discussed, of course, we saw Nifty clocking that 21,000 mark. Want to get in your thoughts as to, do you think we are going to head higher, or do you think some bit of consolidation is likely to kick in here?
Good morning, Nalita, and good morning to all the viewers. Yes, we discussed that last time when we met, and thankfully it played out the way we expected. And we saw a very strong rebound in the market. The biggest fear which we discussed last time also was about this policy continuity and the continuity of the government, which can possibly is the most important factor. And I think with this resounding victory in these three elections, market is clearly discounting that general election in May 2024 is more like a cakewalk, or possibly the probability has gone up much, much higher. And if you see, Nandita, this is the first time we have seen FIs turning around very, very strongly. Right? If I see the last week, Nifty possibly has gone up 3.8, 3.9%. But it is also the time when we are seeing that this large cap index has outperformed mid and small cap in the week. Right? And this, we have seen almost more than $3 billion of inflows by FIs in the last week itself. I think so far in the month of December, we are above $2 billion of inflows. But this tide turning around, possibly taking out one of the biggest risks of this election, is giving a lot of confidence to the market. And if you, obviously we saw Nifty touching 21,000 in the short term, but we have to really understand that this week will not be, in very short term, this week will not be like what we saw last week. There are a lot of big events which are piled up for this week. Obviously, we have the CPI data in the US. We have, Fed decision which is coming on 13th. And we also have BOE and ECB's decision coming out. We understand that inflation number, we saw what happened in China on the inflationary side. But, until these numbers are printed, we can see some volatility coming during this week. But if I see the whole month, we expect this market to show more strength because, possibly no big negative news will be taken as a positive news. And turning around of FIs will definitely support the market in the coming weeks.
Right, Aishwarya, we're talking about levels of 70,000 on Sensex, right? I mean, just a few months ago, we were asking our experts by when do they expect Sensex to hit 1 lakh? So, the answers range from 3 to 5 years. But now, do you think that will be preponed and perhaps we could look at that level in the next 2 years itself?
That's a tricky one, Anita. But what we expect that market should be compounding it anywhere between 12 to 14% for the next 3 years. Because as we discussed, the kind of work this government is doing and the kind of earning growth which we are expecting on the corporate profitability side. So we are close to 5% of corporate profit as a percent of GDP, and we expect it to inch to 7% in the next 3 years. And if that happens without any glitch, 70,000 could just be a formality. So 1 lakh could just be, a formality given the kind of compounding which you will see in this earning growth for the next 3 to 4 years. So everything boils down to earning growth, and which we believe have a very high probability to turn around of 12 to 14% in the coming years. So I would advise the viewers to not just look at all of these eye-catching numbers of Sensex hitting 100 lakh, 1 lakh or something like that, or Nifty moving up more than 24,000. What is more important is whether these corporates can roll out earning year after year, where we have the ability to create and separate those numbers. That is where the wealth creating opportunities lies in data. And I think there is a very, very high likelihood. As we discussed, this kind of GDP growth we saw. And obviously when RBI came out and revised our GDP guidance from 6.5% to 7%. And we all know RBI is pretty conservative in its thought process. So possibly 7.5% to 8% GDP for the next 2 years is very, very likely. And we discussed that, the kind of gross capital formation which has been created over the last 6, 7, 8 quarters. We believe it will continue to support our GDP growth. And on top of it, if we add 4 to 4.5%, 5% kind of an inflation, a 12% kind of a normal GDP growth is very, very likely for the next 2 years. And if you convert those into revenues and earnings, a 12 to 14% compounding of, stock market is quite doable for the next 2 to 3 years. So I believe strongly that the next 2 to 3 years is going to be a big, wealth creating opportunities for the country. And investors has to do just one thing. They have to invest their money into high quality businesses where there is an extrapolation of earning growth is relatively easy. And the rest of the job will be taken care of the market rather than focusing whether we will touch 1 lakh in Sensex in next 2 to 3 years. The Sensex possibly will not be, I would say, investable thing other than investing in the countries can create this wealth creating opportunity for the investors.
Right, speaking about sectors now, how would you approach the realty space now, given the fact that, there are reports that are suggesting that real estate's inventory has surged to over 1 lakh crore rupees, outpacing sales growth. But given the fact that realty, in the rate sensitive basket has been an outperformer, realty index up 70% on a YTD basis, stocks have done fairly well. Do you think it's time to turn cautious when it comes to the entire real estate space?
So, if you have seen the value in the real estate, which has been primarily, supported in spite of higher interest rate, was the kind of consolidation we have seen in the sectors. The big players are becoming much, much bigger, and smallers were finding it difficult in a rising environment, inflationary, rising interest rate environment. And obviously, because of the push on the infra side, the push on the realty, have created a lot of, good sales growth, especially in the discretionary part. I won't say the same for low ticket housing, but on the discretionary part of the businesses, we have seen very strong growth in the last 4 to 5 quarters. But at this juncture, when we see that, possibly that softening of interest rate is around the corner, and we will also see, if we look at our liquidity at the banking level, we are slightly under contraction mode over the last 2 months. And it's just a matter of time. We will see easing of liquidity by the RBI in the coming months, and possibly a rate cut by, mid of the next year. I won't be surprised that even if you see a rate cut earlier than what even the US does that, possibly we might not do a very steep rate cut, possibly we'll do announce a lot of liquidity, easing measures initially, and then possibly do a rate cut of 25 or 50 basis. It possibly will be shallow, but it will bode very well for the real estate. So there's a low ticket sizing, which we have not seen much kind of a growth over the last 2 to 3 years. Possibly we'll see a big, growth momentum coming up as the rate goes nosedive. So in that scenario, I believe that there's still a lot of to play in real estate. But one has to be very, very cautious into the names that they are buying. Obviously, as you said, we have seen a good rally. So risk reward is not that favorable, but I believe there is still a lot to go in real estate sector per se. Another thing is if someone who is, want to really play this real estate sector but doesn't want to take that kind of a risk, they can always play a proxy on real estate sectors. So instead of buying, businesses who are into constructions or real estate, they can buy proxies of whether they can get into tiles player or they can play into plywoods and, paint players, because these are all proxies on real estate where you can find a better quality management, where you can find better balance sheets, better visibility about growth. Compared to the ups and downs we normally see in the real estate sector. So those are investors who want to play safe, can play through that. But anyone who's already invested in a real estate sector, I personally believe there is more to go into this.
Right. Very quickly, how would you approach the sugar space, given the fact that there has been curbs on ethanol production, right? And that is expected to weigh on earnings for some of the sugar stocks. So, would you advise investors to avoid this space completely at the current juncture, or do you think the dips should be utilized to buy into them?
So, at Fident, we normally don't invest into sectors where there's a huge amount of regulations by the government, because it's very, very difficult for us to extrapolate things in the future. And we have historically that we have seen is super are the stocks where, those dictates of government always have a play on the sentiments of the sectors. So obviously we stay away from those, but any investors who are pretty interested into that, we always recommend that there's always a buying opportunity when such negative news hit the market, because that is where you try to average down and then bring your cost much, much lower. It's very, very difficult to tell on what the next level of, visibility about those regulations and dictate, which will have an impact or the corollary impact on the growth profile and the cash flows of these companies. So as an astute investor, we stay away from this sector which are regulatory guarded.
All right. With that, we are running out of time. Thanks a lot, Aishwarya, for taking out time and joining in and sharing your thoughts with us. Always a pleasure.
Thank you. Thank you. Thank you, Nifty. Thank you so much.
Well, with that,